Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the Dow had its best week of the year. Gold kept its head up, but crude struggled a bit. Ross also tells us shrinkflation has hit the cruise ship industry. Publisher of the Leibovit.VR newsletters, Mark Leibovit checks in from Arizona to talk about how high the Dow could go, the future of crude, gold, and the U.S. dollar. He also says we're facing a major solar storm over the weekend that will see northern lights visible as far south as Alabama. Mark also has a special offer for our listeners. Author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, talks about all things real estate, including mortgage rates. He also comments on electric vehicles. Plus, at the end of the show, we'll have a company showcase update from the Director of Marketing for RecycLiCo, Tony Mitchell. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Inc. trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show, Ross.
Good to be back. You take 10 days off and nothing falls apart. Things keep moving up. It's quite the resilient marketplace out there.
How would you describe what happened on the stock markets this past week?
Well, I think this was, 7 or 8 days in a row now for the Dow to be moving higher. I think it's the best week of the year from what I hear. And when I take a look at, like the S&P, before I went away, we were down at 5,000 on the S&P futures, got some good oversold readings, actually one of the best ones that we've had in almost 3 or 4 years. Sort of an oversold uptrend, and here we are at 52.50. So just an excellent stretch. We've taken out a number of resistance levels, and the key one that you're going to be watching for with the S&P right now around 52.50. The key resistance is started about 5,400 on the futures contract, so another 150 points above here before I think you see some pretty decent overhead. And as we're past the best 6 months of the year, quote unquote, you'd expect to see some choppy action as we move from here into the summer. So and then who knows? The classic would be a correction starting in August and running into September, October, but for now, trends are up, and there's, a change in leadership. It was the FANGs up until February, and if you look out there now, the utilities, you look at the XLU, U.S. Utility Index, just having just a fabulous run here. Even the Canadian Utility Index doing pretty well. So as long as there's rotation, the money will find a place with opportunity, and it will run to it.
What's going on with gold and silver?
Excellent week this week. Move in gold back up to 2360, up from under 2300, and we are. It's been the better part of a month now that we've been stuck at 20. We'll call it 2360 plus or minus 50, 60 points. This consolidation has been sort of, I think, normal to see after that massive rise that we had in the first calendar quarter. I think the important part here is that when you look at the related stocks, the GDX, the GDXJ, and then over to silver, the SIL and the SILJ, those ETFs have closed now at the best weekly level in 2 to 4 years, depending upon the index you're looking at. So when you're seeing the stocks perform as well, if not better, than the underlying commodity, that's a pretty positive trend. So, the big names, the Kinross, the Wheaton Precious Metals, the Agnico Eagles are just screaming along here, doing exceptionally well. And even the minor stuff, you take a look at the junior stocks, we've got a list of them that we track, and I think of 13 or 14 that are on the list, all but maybe 2 of them have just been off to a great first half of this year. So happy to see this. The key resistance level, I think, for gold continues to be the next Fibonacci level at 2460. We got up within $30 of that in April on the first run, and if we consolidate around here for another, who knows how long it'll be, but if we can manage to take out that 2460, I don't have anything in the way of resistance until we get up to about 3,300. So there's a big vacuum in terms of my price projected levels. So now I've got a pretty good feeling here that we're going to find our way up there in the in sometime in this next year or so.
What's going on with crude?
Crude's had a rough week. It has been trending lower, and we are not only under the $80 level, but we're down around 78.25 at this point. The seasonals sort of ran their course from the January level up until April, and a late March into April is classic for a seasonal high. Got some good overbought signals up there. And the pullback at this point, for all that it's been a good $10 off the high, I'm still not getting it into oversold territory. So it's going to take some deeper breaks here before I think you see of anything of a decent low. You want to be patient. The oil stocks have been doing not too badly, holding up here, I think, because of all that's going on in the stock market. But the commodity itself is not something to be jumping into just as of yet.
What's happening with the U.S. and Canadian dollars?
U.S. dollar, just a quiet stretch here. We've been in this, once again, trading range. We were up around 106 and change before I went away. Got down to 104.5 and kissed against the 20-week or the 50-day moving averages, where there's some decent support in here. Not a lot to write home about in there, and if you take a look at the other currencies relative to the dollar, I don't see anything jumping out for the other major currencies. However, the Canadian dollar, we take a look at it and compare it to the commodity indices. So you've got the CRB index and also against the oil price. And the most recent low that we had here in the commodities just 10 days ago, the Canadian dollar did not go any lower than it had been. So we've got a divergent low, a bullish divergence here in terms of the Canadian dollar. It sort of offsets the bearish one that we had 2 months ago. And with bullish divergence in place, the Canadian dollar has a chance to maybe bounce better than it has so far. It has been a reasonable move off the bottom. We were under 72.5. We're now up to 73. There's some good resistance around 73.5, but if they don't come up with any negative divergences in here, could get a chance to run, another 2 or 3 cents.
Ross, has shrinkflation hit the cruise industry?
We were away the first time out of the country in 4 years between health and COVID and everything else going on. It was the first opportunity to be away. And I think it's about 6 years since we were on a cruise ship. Let me tell you, they're scaling back on everything. The size of the cutlery, the forks and knives are not as big as they used to be. And everything in terms of the servings is just scaled back a bit. So, if the cruise industry is doing well, they got lots of people on very, very big ships, and the ships are getting bigger and bigger. But you aren't getting quite the service that you did a number of years ago.
Well, with the size of the ships, I'm surprised they don't have travelators to go from one end to the other like big airports have.
Yeah, but with these medallions that you have on when you're on the ships, they know exactly where you are, and it's great if you want to find your friends that you're traveling with. But if you don't want to know where they are or have them on top of you, I don't think there's a way to turn off that medallion.
Ross, thank you so much for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Coming up, Mark Leibovit, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be here, Jim. Thank you for having me.
Mark, do we have a special offer for our This Week in Money listeners?
Yes, we do. We try to offer them a discount, and it's a 50% off of any of our newsletters, including our very famous annual forecast model, which we've published since 1987. Go to VRTrader.com, open the screen, and you can see all the choices, including the VR Forecaster. And then the promo code, when you place your order, you enter the promo code 2022 half off. That's 2022 half off, and you get a 50% discount. Also, I want to disclose that I'm not a financial advisor, nor do I provide financial advice, since I no longer manage money.
Mark, can you tell us a bit about VRTrader.com?
VRTrader.com, VR stands for Volume Reversal, which was a technical tool that we use primarily for our trading. We use a few other indicators, but if you look at our screens, it's very simple. If you actually want to use the VR indicator, there's only one place you can go to do that. It's a service called MetaStock, M-E-T-A, MetaStock. They're a platform, and you can actually license the use of my VR indicator up there as an add-on indicator on the screen, so you could see what I'm seeing. The VR is essentially a change of price and a change of volume, coming off hopefully lows and highs, which is where we signal the greatest profit potential trades, and it all comes from the theory that volume precedes price. Over the years, I've incorporated other technical indicators, but my approach is really simple. I use some cycle work, which we talk about on these interviews, times of the week, times of the year, or so forth, like a turnaround Tuesday, for example. A lot of the stuff was inspired by Yale Hirsch's Stock Trader's Almanac about certain time periods, like the Santa Claus rally or the turkey shoot around Thanksgiving, and all these fun things that affect the market, cyclical factors like where we are in the seasons, and then we also look at lunar cycles and so forth. But we want to get a sense of timing, plus it's like the weatherman, you have a big picture forecast, look out the window before you actually pull the trade. So that's where the volume indicator comes in, looking at your charts and say, well, this is a time for a low. Are we getting confirmation of that? So we do a lot of that kind of stuff. And, I'm proud of the fact that I'm a survivor. I'm still doing this since we launched the product and the newsletter back in 1979. It's like 45 years, and it's also a lot of fun. We don't talk about this very much, but the horses are at the gate at the opening every day. We gate opens, we see where the action is in terms of short-term trading, and also in terms of just analyzing on a daily basis, what's happening, what stocks and sectors are moving. So it's something I've always believed, Jim, that the closest thing we have to a crystal ball is the markets in terms of what the future is like for us, in terms of any event on the planet is affected in terms of price or in terms of the specific sectors in the market where you see things ahead of time. So smart money knows where things are heading, and that's why I say the markets are your crystal ball. Money is raised for new technologies, so forth and so on. Whether you're a believer in pharmaceuticals or internet, AI type products and so forth, oil, gold, the whole schmear of opportunities that are out there. So PR Trader incorporates all of that in sort of a roundabout discussion of what I do.
Does it look like the Dow's on its way to 40,000 and beyond?
Looks like 60,000 to me, actually, but I don't have a time frame on that. I'm guessing, in the next 5 years or so is a possibility. I'm a little worried about the markets going forward the next couple of years with what's going on in the world. But, look at how many disasters and tragedies and negative events we've had during the last 100 years of the market since the crash in 1929. And yet, even 1987 and so forth, 2008 and 9, market always seems to come back, and that's because governments around the world continue to print money. And we have agencies like the Plunge Protection Team, which Ronald Reagan created back in 1987, the Working Group of Financial Markets, it's called, and the governments are in there, pushing prices up, both for their own survival and that for the country. Japan is notorious for this. We've talked about this before, their involvement in the markets and ETFs and stocks. So the answer to the question is, there are shakeouts, there are black swans, which I've predicted a few of them, and we've seen some in the last year or so in terms of these sudden unexpected events. And Hamas-Israel war was one of them. The banking crisis last year was another. And now in this past week or so, 10 days, we're experiencing horrendous amount of bad weather in the United States, stretching from, I would say, Texas all the way to the Northeast in the form of tornadoes, very destructive. These are sort of black swan events, things that you just can't predict that come. But despite all that, markets come back. We have hurricanes and earthquakes, a lot of disasters. Ultimately, if there's a polar shift or asteroid or something, super significant, then that's a whole other story. But as long as mankind is in control of the financial purse string, so to speak, markets move higher. So I'm a little more concerned about the markets at short term here. But to answer your question, 40,000, I can't give you a time frame. That's not that far away. It's only about 500 points, and 62,000, is probably coming in the next few years. And if you're a long-term player and you just dollar cost average in the markets, meaning you just put a fixed amount in every month and you have enough of a time frame. If you're 80 years old, it's not going to work for you as well as if you're 30, but it will ultimately work out for you, unless, of course, you're a trader, and then the long-term viewpoint is less important to you.
Could the S&P 500, NASDAQ, and even the Russell 2000 all be on their way to new highs?
I can't say no. You got so much government intervention and manipulation out there. The street is fixed on the Federal Reserve. It's almost insanity to the extent that they focus on what the Fed's doing or not doing in terms of lowering interest rates. The market's been anticipating it. It could happen at any moment that they just break them out. I don't think the Fed's lowering rates right now, but the big story is that the Fed has very little control of what's going on anyway. The bond market is independent of the Federal Reserve, and the bond market does its own thing. Federal Reserve just controls the short-term rates. And with international conflicts going on, geocosmic events like the solar storms we're now experiencing. We'll talk about that in a moment. All kinds of things out there, affect the markets on the short-term basis, and certainly the traditional summer rally could be underway. I'm a little more cautious than that. My work is saying we're overdone here a little bit, and we need to pull back more before we take off. Some of my cycle work says we probably should see a low this summer, and then, of course, traditionally you get the August-September sell-off, and we got the elections this year, so a lot of volatility. But despite all the negative news out there, markets have held up pretty well. I'm not chasing stuff here. I'm just very selective at what I'm looking at the moment. But overall, you have to be bullish because of the manipulation of the markets on the part of the government, the strong push on the part of money managers who are always bullish. When you see interviews on national TV, they're biased to higher prices. So, barring some extraordinary black swan event, which, can happen at any moment, they probably will take them higher.
What are the Dow transport signaling?
Transports are an important factor for me, and if you're a technician in the markets, you know that over the years, Dow transports, it's sort of the tail wagging the dog theory. The Dow transports, there's a theory called the Dow theory. It's been Charles Dow, the creator of the Dow indicators, was 140 years ago. Basically says the various Dow components, the Dow indexes, have to be in sync. You have the Dow industrials, you have the Dow utilities, and the Dow transports. Just backing up to the industrials for a second, I know I'm getting off the subject, but it's so changed and manipulated since Charles Dow created it. It's really unbelievable. Virtually none of the stocks that were in there when it originally was created exist, and it seems like a stock gets hot. A stock that's not hot is taken out of the index, like Apple's put in, and International Harvester comes out. I mean, just over the years, it's a manipulated. I hate to keep using the word manipulation, but that's really what the story is about, unfortunately, on Wall Street to a great degree. If you keep taking out the losing stocks and putting on the winners, you have the bias to higher prices. So the Dow Industrials, I don't have much regard for it because of the way it's created and adjusted, but that's the reality, and you have to sort of live with it. But the Dow Transports theory is that the Dow transports need to confirm the move to new highs, relative highs, and at the moment it's upticked a little bit in trading today, Friday, but it's still well off its peak from about a week ago, and the Dow Industrials seem to be closer to their highs, but not the transports. You're getting what's known as a negative divergence. You're not really getting confirmation. And when you think about it, business is conducted, inventory, products are shipped, and if a lot of business is occurring and it's active, you're going to see it in the transports because things have to be shipped and delivered. So it's an important indicator. Nothing is 100%. It upticked a little bit today. Maybe it'll take off here and confirm. But if it doesn't, you've got this negative divergence. So transports have been a bit negative here and really haven't confirmed to the extent that we would really like to see. And, it's an adage, it's been around a long time. And, at some point, maybe it has less significance than when it was created, over 100 years ago. So, but that's the theory with the transports. It's upticking, has not confirmed the move in the Dow yet, which creates, in my view, a little negative divergence for the markets here, which is another reason why I'm not jumping up and down here buying stocks like crazy at this moment.
Crude oil is off its recent highs. What do you see ahead for crude?
I'm sort of a perpetual bull on the oil market. I mean, first of all, the oil stocks, the companies are doing great. They're making a lot of money. Exxon just took over Pioneer Oil and Gas, and which makes it one of the probably the largest oil company now in the world for sure. Oil hit a little bit of a trading top here, a double top, but I'm in the bull camp looking for huge numbers to the upside overall. As a trader, you can make your decisions day to day here. It's a little bit of a pullback the last 4 or 5 weeks since it peaked out, but I'm holding the oil stocks. I still think they're not only the company's doing well, but there's still shortages out there and a lot of need for the oil internationally. OPEC may still be aggressive in terms of trying to cut back production, which I still think is likely, and that we still have huge crises in terms of wars underway. No one likes to talk about World War III, but in reality, when you think about all the shooting that's gone on in so many hemispheres here in the recent few years, you got to believe the war is already underway. It's just not being talked much about. So the serious stuff going on between Iran and Israel and Hamas and Ukraine and Russia, and North Korea's out there playing around, and we don't know what China's going to do or not do. So this impacts oil, and I think demand is still huge. Plus, customers have lost their taste for hybrid to a certain degree. A company like Rivian, which was a new hybrid company, had a lot of problems here. Tesla's cut back on their production. So people have decided they want gasoline, hybrid vehicles in particular, or just regular, gasoline vehicles, and that's supportive. We also have summer driving season coming up, so that should be supportive. So I'm going to remain bullish.
Does it look like Bitcoin topped in March?
It did, but it's temporary, and the question is, you got to be prepared for volatility. And a lot of new players that got involved in it after the ETFs were created. BlackRock, Larry Fink's ETF, of course, GBTC, and all the others, have big run on the initiation of those. My charts are saying looks a little, still a little toppy here, but with potential in terms of Bitcoin in the 80,000-90,000 range and 100 to 150,000 range, and the state of the world, government involvement, distrust of government, distrust of currencies. You got to be in there, and the question is what allocation you want to put. So Bitcoin got into the low 70s. I think it was 73, 74,000. It dropped into the high 50s. Now it's back into the low 60s. I mean, it could go back to the 50s or even the high 40s on a sharp sell-off. It could happen. We've seen it before. You just got to be prepared for that. So it depends if you're trading this thing day to day or not. The overall chart pattern is leaning a little more negative here. I'm looking at my screen now. I have a lot of these, what I call negative volume reversals that have come up since March. Rallies, the negative volume comes in, and some selling comes in, and rallies, and more negative volume comes in. So there's some selling in it here, and maybe we're going to see another bit of a correction in it. So I wouldn't be whole hogging it here. You got to keep a core position that's like owning a little gold or anything else, but I wouldn't be surprised if there's another shakeout in it, and you can pick it up a lot cheaper, and it could be anywhere from 40,000 to 50,000 range in Bitcoin if it does have a shakeout. I'm not positioning for that, but I could see where that could happen in a sharp sell-off, and that would present a great additional buying opportunity. So tad cautious on it here. I'm holding a very small position, but it looks a little bit toppy to me.
Gold has pulled back from new all-time highs. What do you see ahead for gold?
Well, I'm sticking with my target there. I had to suck my neck out a little bit with a $2,700 target. I was hoping we could see it this year. BRICS is very active out there, accumulating gold, trying to get another currency underway. China's, Russia, they're just accumulating all the physical they can get their hands on. Some of the shares are starting to cooperate now. There was some negative divergence there with the shares, the gold shares not confirming or rallying as they normally should, and they're starting to do that a little bit. Silver is also a play here, so you got to be in there. I mean, we've had a multi-year breakout. We've learned, over the years that it can become very volatile. You can get $300-400 shakeouts in gold and back up again, and we had to move over 2,400, and we got under 2,300, and now we're moving back up again. I mean, I don't want to say it can't happen, that we have another shakeout, back to 2,000 or something like that. Anything is possible, but the charts are positive. And with what's going on in the state of the world, with inflation still there, despite the talk that it might be coming down, most of the numbers that you hear, in fact, probably pretty much all of them, unless they're industry generated, most of the government numbers are false and they're manipulated. So I would be keeping my positions and looking for hopefully continued strength here through the year. And I hope to see that 2,700, and whether we see it this year or early next year, that's sort of my target. But, there's more money in the shares if you can catch some leverage plays, particularly with some of the double long ETFs in the stock, like Nugget or JNUG, which are NASDAQ ETFs on the long side that are playing shares on a double basis, like 2x their normal volatility. So remain positive.
The U.S. dollar continues to show strength. Are you bullish on the U.S. dollar?
Yes. And one of the reasons for that is it's sort of complicated, but the activity of central banks in the gold market helps the dollar. And I describe that detail more in the newsletter. But actually, the movement into gold on the part of foreign banks, since they have to transact in U.S. dollars, actually drives the dollar higher. So there used to be the adage out there, which I long ago warned about, is that you see an inverse relationship between gold and the dollar. That has worked, but many periods of time it doesn't work, and they can move in the same direction. So I think you're in the dollar-gold rally sequence, and I'm not worrying about the dollar moving higher, which it has been in terms of being a contrary indicator to gold. So still overall positive for that reason, because of the gold, and you might also argue flight to safety. In terms of, is the dollar the last survivor or last surviving horse in the glue factory? You know what I mean? And where are you going to go? You want the yen? You don't know about that. That's been uncertain recently. Do you want the pound? Do you want the Swiss franc? Swiss franc might be an alternative, but it seems that money still flows into the dollar. So particularly if there's world crises out there, for the time being, the dollar is still the king currency, and the attempt is to dismantle it. And, we'll see how successful BRICS and the rest of the world is in doing that. So the moment that's not the case, but there is that attempt. I would say this: if the dollar really does go the way of the glue factory and all the other horses, the world's in a lot of trouble, because then we'd be depending on the new BRICS currency or other nations' currency, and we don't know how stable that will be. We just don't know. Maybe that's the reason why money is going into gold and money is going into Bitcoin and its alternate means of transaction, because of that uncertainty. So that's why you got to keep a position in Bitcoin or crypto, in gold and so forth. You just can't put all your eggs in any one investment or basket, so to speak. But I'm going to stay positive on the dollar for now, despite the attempt to take it down.
Do you think higher or lower interest rates are just around the corner?
I have a mixed feeling about the rate situation. I think we're misinformed about inflation. We get nothing but lies in terms of government statistics. Obviously, there's a presidential election coming up with a lot of political influences here. We're not really told the story. My gut feeling is that, the surprise could be higher rates, and for reasons and for factors that we have little or no control over, that we think we have control over. The Federal Reserve doesn't have the power to control inflation, though they're trying to do it in their own meager way. There's so many other forces at work. The biggest surprise to anybody would be the Federal Reserve having to raise interest rates. First, as you know, they want to, or anticipating, 5 or 6 rate cuts this year, and now they're hoping to get only one. I mean, it could be a surprise, Jim, and suddenly the Fed turns around and jacks rates up again. And boy, the stock market wouldn't like that, since all the money managers on the planet are positioned for the Fed lowering rates. There's actually, if you look back at history, some of the times that the Fed actually lowers rates, usually the market, that is the stock market, goes down. And the reason they lowered it, because of some crisis unfolded, and they had to lower rates just to overcome the selling or the negatives that were taking effect at that time. Now, whether this scenario, history doesn't always repeat itself the same way, is the same or different than in the past. But if they may lower rates because of a crisis, that another black swan, so to speak, that we have yet to experience. But when you ask me about where rates are going overall, the Fed's not rushing to lower rates, and even though their work is ineffective and really doesn't control the direction of inflation, then the surprise might be higher rates, which would really blow off the minds of these traders and these strategists. The other thing to mention, I'm not an economist, but the Fed has a lot of tools. We got to talk about the plunge protection team out there, which may be run by the U.S. Treasury and so forth. And the Fed does all kinds of crazy stuff. But one of the main things that they do, which is not talked about, is their control of money supply. And if they restrict the money supply, that's how you bring markets and business down, tightening of credit, the inability to get loans and so forth. And the Fed hasn't been really aggressive in reducing the money supply. In fact, they've been sort of supporting it to a certain degree if you look at the charts. So if they really wanted to bring the markets down and really do a number on the economy and do what Paul Volcker did back in 1980, they would really restrict that money supply, make credit hard to get, all kinds of stuff, and that would really bring the markets down and probably would, get them to that 2% target that the Fed keeps talking about. But it's politics. You got an election year. There are too many variables out there with the geopolitical situation. They're keeping money loose. We have a lot of banks that are still in trouble in the U.S. Every few days you hear about another bank that has been taken over by the Feds, mostly the small regional banks. And I don't think they can afford to take the risk of tightening that money supply, which they really would need to do to really put the clamps on any inflation risks. So for that reason, I'm more in the interest rate staying the same or higher and inflation staying the same or higher for the time being. It'll be interesting after the U.S. presidential election what really happens here. But the trends are still in place and status quo as far as I'm concerned.
In Canada, home prices peaked in early 2022. Sales are down, inventories piling up. What's the state of housing in the U.S.? Do you have a bubble that might burst?
I'm not looking for a bubble. Wow. I think there's still a shortage of product. Many people who own homes, don't want to sell unless they decide they want to live in their RV or camp out in their tents, because to get another house, they have to pay double the interest rate that they would have had on an older mortgage. So that restricts supply and availability, which keeps prices up. There's still some supply shortages in getting things done. Construction is not as fast as the contractors would like. There's still some supply chain issues. So I'm still, and it's also a great asset. In other words, if we're still in an inflationary environment, which I believe, real estate, we didn't add that to our list before with Bitcoin and gold, but over time, that's still another great alternate asset, doubles every 20 years, according to the rough rule of thumb. That should support prices. So I'm not saying you can't have a little downtick, but the markets, I think, are still fundamentally strong. People need places to live. Rents have been going up. People are still looking for places to buy. Some builders are, in fact, here in the Phoenix area, I got some emails, about builders offering really low rates on new construction to get you into the project. Some like 4 or 5% range, which is 2% under the conventional market. So the answer is I'm bullish. I think real estate will hold and go higher.
On the geocosmic front, we're into a major event, aren't we?
Yeah, we didn't talk about that. Only hinted at it earlier. It was reported on spaceweather.com last couple of days that we might experience a new Carrington event. Now they're backing off a little bit from that, and actually some of the visuals on the website compared to what the Carrington event, which is basically a huge sunspot on the surface of the sun. Love talking about this stuff and tracking it. So meanwhile, we're really we're experiencing a big geomagnetic storm right now. Apparently, according to the scientists at the Space Weather Group, we're experiencing the first of 6 CMEs, which are the attacks of energy on the planet. There's a giant sunspot out there, and apparently that's the thing that triggered the Carrington event, which back in 1859 when it occurred, it caused, havoc on the planet. But at that time, we didn't have much electronics out there. It was mostly the Western Union and telegraph. But right now, it is affecting the planet. There's some, shortwave radios are being affected. It's supposed to carry through the weekend. So this is, they said it might be like a Category 4 versus a Category 5 or greater, which would be really significant if it happened. I mean, we experienced geomagnetic storms to the extent of the Carrington event, and it's coming. Whether it doesn't appear this weekend, this is the case, but when we get one of these, it could wipe out satellites, all communication on the planet. You'll know it because everything will go down. So hopefully that doesn't happen, but it's really interesting how this is something not really talked about very much. That you hear something from 1859, and again, sunspots occur, and at one point we're going to get a huge one, and maybe they're wrong. We will get a big surge this weekend, but it's really interesting to track. And it just humbles you about humankind and economics and the stock market and what's going on in Ukraine or Israel or North Korea. I mean, we're ants on the anthill. And, this is why I track this stuff, because, we think we're so all powerful, and, following cycles over the year and the position of the seasons and how markets change at certain times, and how you see market highs and lows tied to lunar cycles. And we have these tremendous tornado storms running through the U.S. now. We have little control of our future, and you can talk all day long about money supply and military strength and all kinds of nonsense. But as a planetary event, it's like those ants on that anthill. We're nothing. So it's just interesting to track. Obviously, when it occurs, we'll have no control over it. Hopefully, no one gets hurt seriously when it does happen. Barring a polar shift or an asteroid or something, totally, which is totally out of control. We should survive these things, but it's interesting to track them. It's nice to know they're coming. I mean, there's some ways if you plan for a geomagnetic storm, you could shelter your equipment, you can get certain protection devices and things up. But if a super one hits and the whole system goes down, there could be big problems in terms of delivery of food and power and water for people. So hopefully that doesn't happen. But anyway, it's interesting that it's occurring right now. And for those who are listening, if you want to go to spaceweather.com and just follow the stories on the geomagnetic storm or future storms and see what the future holds for us in terms of the sun.
On the positive side, Mark, the U.S. National Oceanic and Atmospheric Administration, known as NOAA, says the northern lights will be seen across all of Canada and as far south as Northern California and Alabama. So at least you'll get a decent light show out of it.
Right, because the CMEs from the sun help trigger the auroras, and the more dramatic they are, as you say, the further south you can see them. So looking up at that night sky, you'll see the northern lights, and which is in effect an expression of the magnetic field being impacted by the storms.
Yeah, the Van Allen radiation belt deflecting the sun's rays.
That too, correct.
Yeah. Mark, where can people find out more about your special offer?
Go to VR Trader, Victor Robert, VRTrader.com, and enter the promo code 2022 half off for any of our products and get that 50% off. Thank you.
Mark, thank you so much for being on This Week in Money.
It was a lot of fun. Thanks for having me.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He was speaking to us from Arizona. Coming up, Hilliard MacBeth, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Inc. trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to This Week in Money.
It's great to be with you again.
Hilliard, can you tell us a bit about your second edition of the book, When the Bubble Bursts?
So the book came out in 2018, so that's now, 6 years, and it basically suggests that eventually there will be a bursting of the housing bubble, and it was early, obviously. But now we're seeing a lot of signs that the housing market is in the early stages of a correction, which fits very much with the explanation that I give in the book. So if people want to know what's happening right now in the housing bubble and the correction that's happening, the book is excellent. It's available in all the large bookstores and on the ebook sources like Amazon and Kobo and that as well.
Are you bullish or bearish on stock markets going forward?
I'm bearish for the short term and bullish for the long term. So what we've got right now in the stock market, which is difficult, is interest rates have risen, but the full impact of that hasn't worked its way through the system. And the valuations on the stock market, especially in the U.S., especially in what they call the Magnificent Seven, are as stretched as they've never ever been. Like 1929, 1999, 2000, we're in that kind of nosebleed territory. So in the short run, by which I mean the next 3 months, 6 months, 9 months, I would be worried about a correction, perhaps a significant correction. And in the long run, the stock market will do very well, as it has for many decades.
Of course, wait for the crash and then buy the gold chip stocks when they're low.
Yeah. The trick would be to pick which sectors are going to do the best, and that'll be a challenge. But we're doing a lot of work on that now. But it's not that fruitful to make up your minds before the correction, because the correction will bring some big surprises with it, and that's when we'll know more about what the best place to be. But like after 2009 and after 2002, those two big corrections, the recent ones, you could buy, as long as you bought a broad range of securities, you did very well in practically any sector.
And of course, there's always spectacular crashes in sectors. 1929, it was RCA. It was called Invest in Radio. You can't miss because radio was brand new. The 2000 .com, anything with a .com on it, everybody snapped up. Now, companies attach the letters AI, and people are snatching them up. Are those the ones where we're going to see the biggest crashes?
Well, it's certainly the story. So these peaks in the market are usually accompanied by stories that justify why you should buy at these very expensive valuations. And the current iteration of that is obviously artificial intelligence. And the thing that's missing in this is the explanation as to why artificial intelligence would generate all these profits for these companies. So that's the danger thing. When you see a story, and the best stories like that are ones that come out that they don't have any dollars and ratios attached to them. They're kind of more like a vague kind of a theme type story rather than a specific explanation of where all these profits are going to come from. In 1999, it was the internet, and today it's artificial intelligence. And so that's a confirmation, basically, that we're probably near the peak of a stock market bubble.
Gold is pulling back from recent all-time highs. What are your thoughts on gold and gold miners?
Well, gold is actually doing extremely well, considering how strong the U.S. dollar is. And, of course, the gold is generally quoted in U.S. dollars, in $2,300 U.S. dollars, so it's a little bit above it. It's actually rallied a bit today. So the average cost of the gold miners now, and they use a very strict calculation of profits and expenses, which includes what they call all-in sustaining costs, which means they've got to allow for the cleanup of the mining situation after the mine is fully depleted. So at that price, the average is between $1,200 and $1,400 per ounce for the major gold mining companies, and the current price is $2,300 an ounce. So you're going to see a lot of big profits from the gold miners, and they've underperformed the price of gold for a long time, probably a decade or longer. So the gold miners are, to me, the better place to go than just buying the gold itself. Besides buying gold itself, you got to store it, and you got to stop people from stealing it and all that kind of stuff. So the gold miners are much easier to buy. You just buy them on the stock market and wait for the profits. And the other thing that's going to happen this cycle, which didn't happen the last cycle, it's been quite a while since the last cycle, is dividends. So the gold mining companies have now agreed that they should rather than go on a rampage of buying other gold mining companies, all of the big companies have promised to give back at least some of the money in the form of dividends. So that's a new development for gold mining companies, and there are some attractive dividends already, but they'll be increased quite substantially with these new prices.
Are most analysts still predicting the Bank of Canada will drop 2 or 3 times with its trend-setting rate this year?
Well, that's an interesting question, because I just happened to be looking at this morning, and the forecasts from December of 2023. This is that's not even 6 months ago, was for several rate cuts in 2024, and now we're looking at possibly one, if that, by the end of the year. So the Bank of Canada can't really cut rates until the Federal Reserve cut rates, unless we get into a really bad recession. And so the Federal Reserve was talking about 3 or 4 cuts this year, and now they're looking at perhaps one cut after the election. So it's going to be hard for the Federal Reserve to cut rates. The closer we get to the election, the more likely they are to just sit tight. And but we had a great economy up till 2009. We had a great economy. The average inflation rate was below 3%, and the average interest rate was 7%. So this idea that we have to have 2 or 3% interest rates to have a good economy is just ridiculous. Like, we can have a good economy at the current rates. We don't need to cut rates.
Do you think potential buyers are holding off purchasing homes, waiting for interest rate cuts?
Well, I talked about the book coming out 8 years ago, and that was the second edition. The first edition came out a little bit before that. I talked to dozens, if perhaps even hundreds of home buyers, and a lot of them were potential first-time home buyers because they saw the book and they thought, oh, maybe I shouldn't buy a home and stuff. My experience is that when they get it in their head they want to buy, perhaps in a new relationship, a new marriage or whatever, or there's a baby coming on the way, they don't make these decisions based on what interest rates are, or they just basically want to go ahead. And so basically what it comes down to is, can they get approval for the financing that's needed to buy that place? And right now the approvals are much more difficult to get, because you have to pencil it in at 5, 6, 7% interest rates compared to 2 or 3% a couple of years ago. So the holding off isn't quite the right term. I think they're being forced to wait, basically would be the description I would put on that. The first-time buyer is being forced to wait until either the house prices come down or the interest rates come down so that they can qualify for that loan.
The Bank of Canada just put out a statement today saying that homeowners are in for mortgage rate increase sticker shock. And the situation is, and I don't know how accurate these things are. They do a survey, and I'm not sure about that. But basically, they're saying about half of the mortgages have already experienced the increase in interest rates, and the other half are going to be completed over the next 2 years. Variable rate mortgages usually go up right away. In some cases, variable rate mortgages don't go up right away, but they go up fairly soon in the cycle. But what the banks and the other lenders are allowing people to do is to keep their payments the same, even though interest rates have gone up a lot. And sometimes that means that they've actually gone into what they call negative amortization, which means their payments are not even covered the interest on the mortgage, and the loan is effectively getting longer and longer because they're not even paying any principal down. They might even be essentially what they're doing is they're borrowing more money. And there's a lot of people in that category. So far, the Bank of Canada and the banks themselves have said that it's not a big problem. People are managing their mortgage payments without too much trouble.
I'm very skeptical about that. I think first of all, the banks don't have any way of surveying they do the mortgage, they don't have any way of surveying the people that are holding the mortgage. I can't imagine the bank has a bank of telephone operators that phone people and ask them, how are you doing with your mortgage payments? Are you able to afford them? It just doesn't seem likely. So what happens is the bank is kind of the last one to find out when people start actually missing mortgage payments. The last thing anybody wants to do is miss a mortgage payment. So they'll run their credit card up to the limit. They'll do everything they can before they get to the mortgage payment. So for early signs, what we need to be watching is things like credit card balances and the people that can't pay off their credit card balances. And that has been going up very rapidly. So we're seeing a lot of increases in credit card balances, which is a sign that people are stressed. And the other thing is insolvencies, both for businesses and for consumers, have started to jump as well. But even that's a lagging indicator because it takes people quite a while before they're able to psychologically get around to the idea that they have to go see a bankruptcy trustee to talk about defaulting on their debt. It's not something that most people want to do. So we're starting to see signs, and and there's more to come for sure.
Are banks getting around these hikes by extending the amortization period? So if it was 25 years, they boost it to 30 or 35 or 40 years to pay it off.
For sure. Yeah, for sure they are. They do. They got banks have a lot of flexibility. They have this thing called forbearance, where for usually in a business loan, they would talk to the business owner and say, okay, you can't pay your loans back the way we agreed. We'll give you a break, a moratorium kind of thing. They call it forbearance. And they give them a letter and they say, you have to meet these conditions. And in exchange for that, we'll give you some time to get back on track and stuff. And that's been going on ever since COVID in 2020. And that's 4 years now. So the forbearance period is kind of starting to run out. And now in the mortgage business, it's a little bit different because, people were giving a mortgage holiday in COVID. I think it was 9 months on average, and that was delayed a bit, and they've started to run into trouble now. And eventually the bank will have to say to them, you know what, we need you to get back on track, and we can't have negative amortization. You have to get back on a 25-year cycle, but. What I think the regulators are going to allow them to do is to make that a 30 or 35-year cycle or even a 40-year cycle.
Yeah, the government recently announced 30 years, I think.
Yeah, and if 30 years doesn't work, they'll make a tweak to it and say 35 years. And if that doesn't work, they'll say 40 years. But the reality is that people are really stretched because they got into too much debt with prices when home prices were too high, and there's no way to fix that. So we're at the point now, and the difficult thing for the government and for the banks is that they were involved in getting people into that situation. So they can't come back to them and say, "Oh, you stupid people, why did you do that?" They were the ones that told them they were approved to do that. So it's going to be a long, drawn out process. But the thing to watch for is things like car sales and Canadian Tire sales and other more discretionary expenditures, which if the mortgage people are in trouble, they will start to cut back on everything else. And we've seen that. Canada's GDP growth has been negative if you adjust for the population growth that we've had. So obviously people are starting to cut back, but you're probably going to see more of that.
In Hong Kong, I think they allow 99-year amortization.
Yeah. Hong Kong's the hottest, one of the hottest real estate markets in the world, along with Vancouver, British Columbia, and Sydney, Australia. Yeah. And everybody's got their own different versions of how to do it. But the thing with Hong Kong, though, is it's been much more volatile than Vancouver or Sydney. Vancouver and Sydney just seem to keep going from peak to peak, except for recently they started to show some signs of cracking. But Hong Kong goes through these amazing cycles where the prices go up and down. So, it's almost a casino over there.
And of course, Vancouver has tremendous population growth every year. Anywhere from 23 to 45,000 more people move into the Lower Mainland. A mid-sized city comes here every year.
Yeah, and you wonder how at some point, if people decide, everybody wants to live in Vancouver. I know that, in Alberta, I live in Alberta, of course, and they sit and watch for Vancouver license plates, because every once in a while people start to say, hey, you know what, I could get a much cheaper house in Edmonton or Calgary. And there have been some signs of that lately, but the pull of the West Coast is still very strong.
Yeah, it's that lack of winter, I think.
Yeah.
Well, the recent stats I just saw, some 2,200 people moved from BC to Alberta. So we had a negative net gain, but BC roughly grows by 100,000 people a year. Yeah.
Well, it's a wonderful place to live, especially in the summer. I'm not so sure about the rain in the winter, but I guess you can get used to it.
Just stay in your swimming pool. Then you don't notice.
Yeah.
Are the banks tightening credit in Canada for loans, mortgages, HELOCs, and credit cards?
Yes, they are. One of the things that the banks were doing, it's coming out now, is they were kind of looking the other way. They would do a certain amount of mortgage origination themselves, but more and more over the last couple of decades, they started to rely on third-party mortgage brokers and people that would bring new mortgage business to them. And of course, the temptation there was for those people to exaggerate the qualifications, like income verification, that sort of thing, on the application documents. And I think everybody was kind of, during the boom, everybody was kind of just looking the other way and pretending it wasn't going on. But very recently, in the last week or so, the Ontario regulator has made a couple of big announcements about mortgage brokers that have lost their licenses and been fined. Now, the fine in the one case, which is one of the most highest volume mortgage brokers in Ontario, was something like $119,000, which sounds like a lot of money, but given the amount of mortgage business that went through that particular broker, it's almost an insignificant fine. And the other thing, I think, was the loss of license for a period of time. So, but that'll send a chill through the industry. So, the banks will start to question a little bit more closely. One of the recommendations is that the lender should be able to access the CRA documentation of a potential borrower, so they could see whether their income was actually what they stated it was, at least what was reported to CRA. That would solve a lot of this problem.
Yeah.
But then what would happen is, of course, that would tighten credit standards by a huge amount, because a lot of people, not to pick on self-employed people, but that is probably where a lot of the fraud comes from. And banks for advertising say, if you're self-employed, don't worry, we've got a special program for you, kind of thing. And if you're a student from a foreign country, don't worry, we got a special program for you too. And so all of that is starting to get tightened up, I think.
Why isn't there more of a push to help housing with prefab homes? I grew up in Grand Cache, Alberta. For a while, one crew could put up a house in one day. 5 or 6 basic designs. You pick the design, boom, there it is. Why aren't we doing that? Is it red tape, permitting, lack of land? Why hasn't government freed up a lot of this vacant land that's laying around every major city in the country?
Well, the vacant land that's sitting around the outskirts of the country is largely owned by, especially in Alberta, but I'm sure in Vancouver or Toronto as well, is owned largely by a fairly small group of developers. And these developers perhaps acquired the land 5, 10, 15, 20 years before today. And they've been sitting on it, waiting for the city to grow out to the point where they can put some houses on it and sell it. Well, in their view, the profit all comes from the land. It doesn't come from the home that you put on it. The home builders make a little profit when they build a home on that particular land, but the developers don't actually, in most cases, they don't actually even build the homes. They provide the lots to the home builders, who then try to make a profit. And sometimes the developers help the home builders when they get into trouble, for example. And it's a fairly tight relationship, but there isn't any room in that for the prefab home people. They would have to get their own land, because the current group of developers wouldn't want to take a lower revenue and lower profit that would come from selling it to a prefab home manufacturer type situation. So it would have to be, and maybe this will happen now with the new government housing program that was announced in the fall and then re-announced again in April. It would have to be government-controlled lands that would allow that as a possibility. But on private sector developer lands, it's not going to happen, no.
What's the real inflation rate in Canada when you include food, shelter, and transportation?
So, I forget exactly what the official rate is, but it's like about 3.8 or something like that. And now the U.S. has better numbers than Canada, so I'm just going to switch over to U.S. numbers here for a minute. The markets, which are very influential in these things, because they're really the only ones that have a big bet, they're putting big money behind, are basically looking at the inflation rate 5 years out. It's called the 5-year forward rate at 2.3%. So they're gambling that in 5 years from now, for the 5 years after that, so that would be from 2029 to 2034, the average rate of inflation is going to be 2.3%. So that is a phenomenally optimistic forecast, because when you really look at it, the actual real inflation rate is probably much, much higher than that. And but it's really hard to say, to answer your question, because when people say inflation, mostly what they mean is the CPI, the Consumer Price Index, but that's not really a good measure of inflation. It was designed in the 1970s, and then it was amended in the early 1980s as a response to the demand for cost of living adjustment clauses in labor union contracts. And those clauses, back in the 70s, we were talking 10% annual increases. Well, everybody panicked. Big business panicked and big government panicked and said, we got to figure out a way to avoid having to pay 10% annual increases in wages. So they came up with a CPI that was not fully reflective of what the real inflation is. So we don't really have a measure of what the real inflation is, but I have seen numbers. So prior to the amendment, so what they did was they amended the way the Consumer Price Index was calculated. And there's a fellow in the U.S. that calculates it on the old basis before the amendment. And in his calculations, if they're accurate, suggest that inflation is more like 7 or 8% and not the 3 or 4% that we're currently seeing. So I don't have any reason to doubt him, but I haven't verified what he does, what his work is. On the CPI itself, if you go back 50 years, the average inflation rate has been around 3. I think it's 3.3, somewhere in that range. So that's still pretty significant inflation. I mean, you lose a lot of your purchasing power if you lose 3% every year for 50 years. It's substantially most of the purchasing power of your money is gone. So, but in reality, if the CPI hadn't been modified and tweaked, that actual rate would be a little bit higher than that.
Yeah, well, they took fuel and housing out of the index. How convenient.
Well, no, it's still in there,
yeah.
But the way they calculate housing is I mean, it's been understated for a couple of decades now, substantially understated.
Yeah.
But now it might be overstated, because now house prices are falling, and the CPI doesn't reflect that, right? So we'll see. It takes a long time for the CPI to reflect the true cost of housing, if it ever does, because there's a really odd way that they put it together.
Is the price inflation on necessities putting the brakes on purchases of homes, autos, other big items?
It has to be. It's like one of the big, I guess the only really big companies in Canada that sells autos. It's a company that's bought up a bunch of other car dealerships. They reported their results earlier this week or late last week, and they're struggling because sales are down. And they gave a bunch of reasons. They blamed the weather. So that was always when a company has bad results, that's often the last ditch effort to explain what's happening. But the other thing is that car payments, the average car payment, first of all, the interest rate on car loans is much, much higher than the interest rate on anything else, and people just can't handle it. Like, they're getting up to $700, $800, $900 a month for the car payment, And when the mortgage payment gets adjusted from $2,000 to $3,000 a month, for example, on top of that, you're going to put on a new car payment at $700-800. Basically, people are just running out of borrowing capacity. So that's the problem. Is basically with the higher interest rates and the slowing economy, it's getting tougher and tougher for people to find the room to borrow any more money to buy stuff. And our economy is built on credit, as everybody knows. But we're just now finding out how, most people, they didn't even pay that much attention to how much they owed. But now you hear people talking about, oh, gee, I can't believe how much my HELOC is costing me. It's a HELOC, as somebody the other day said to me, a home equity line of credit now is up to 7-8%. So for a long time, it was 2 or 3%. And there was nothing to just put another $10,000 on the HELOC to go for that holiday, right? But at 7-8%, maybe there's a hesitation there, or an absolute cancellation is probably what's going to happen.
The Deputy Director of the Bank of Canada declared an emergency for our lagging economic growth, especially productivity. Is this the Trudeau government calling an emergency for something they created?
That's like it's like the arsonist that goes running out in the street afterwards and starts yelling fire, right? So governments all over the world are struggling with productivity. Nobody knows exactly why productivity is so weak, but and how much is the Trudeau government responsible? They've been in there for 9 years, so they got to take some of the responsibility for sure. But they were in a minority government, so who knows? It goes back probably to the government before them, the Harper government as well. But Canada has been severely underinvested in stuff that would make us more productive. So most of that is capital investment in the private sector, research and development, new machinery, equipment, that sort of thing. And those numbers have been trending lower and lower for long before 2015 when the current government took over. So the one area that seems to be really hot in Canada is real estate. So Canada, instead of investing in new machinery and equipment and research and development, things like AI or new vaccines or drugs or whatever, new electric cars, pick something. We went and invested a lot in real estate, and then the irony of it is now that people are saying, well, we've got a shortage of real estate. So how could we have overinvested all those years in real estate and still come up with a shortage of real estate? It doesn't make any sense. But certainly, investing in real estate is not something that's going to improve productivity. There's a minor improvement if the real estate location is close to where the jobs are, and that allows people to move closer to where they work and save some time that way. But even that didn't happen, really. They built the jobs. If you thought the jobs were downtown, then all those high-rise condos that were built close to downtown, you could say that was a productivity improvement. But now with work from home, the jobs aren't downtown so much anymore. And working from home in a 500 square foot condo is not that easy to do unless you're all alone in that condo. So I don't think we invested in the right things, and that's the problem. And you can't pin it on any one government. It was a long-term trend, but certainly the current government didn't do anything to reverse that trend, if you want to blame them for that.
The capital gains tax hike in Canada, is that a productivity killer?
I don't know if it's a productivity killer, but it certainly is hurting a lot of people, or at least it's irritating a lot of people. I mean, it's not as big a deal for the personal, because most people, and my clients generally are much wealthier than the average person, but even most of my clients on average would not be affected by the increase in capital gains if they in their personal accounts, because the first $250,000 of a gain is on an annual basis is exempt. So it's only after you get over 250. Well, most people don't, even with a $5 million portfolio, which is a pretty large portfolio, larger than the average by far. You wouldn't always get a $250,000 gain to be taxed. So and people can modify their behavior to avoid it as well, right? You can sell half the position this year and half the position next year, that sort of thing. The bigger pain is in the corporations and the trusts, because from $0 the rate goes up. Now, people were paying taxes on capital gains. Now they're paying more. So it's not like it's not that big a difference, but it is pretty substantial. So a lot of people had. A lot of professionals like lawyers and doctors had these kind of incorporated themselves, and then they were investing through the corporation. And it seems like this government has been after those people for a while now, because they made some changes a couple of years ago that made it worse for them as well, and then they backed down. And now this one would also make it worse for them, because that's right from $0. There's no $250,000 exemption. So we'll see, because they did when they announced it in the budget. They have to introduce the budget as a financial bill in the House of Commons, and but they removed this particular measure from that bill, and they're going to do a separate bill and a separate discussion on that. So it's quite likely it could be modified or even canceled altogether. We'll see. But yeah, I mean, I don't know. Would somebody move out of Canada because of that? I don't think so. I mean, it's moving. U.S. I had one client that moved to the U.S. long ago. And the taxes definitely are lower. They had a large investment portfolio, and the taxes definitely were going to be lower for them. They moved to Arizona, but it was like a 2 or 3 year long drawn out move, including a lot of preparation and a lot of paying a lot of fees to lawyers and accountants and stuff to do it right. And I don't think people are going to leave Canada for that reason. They're just going to be irritated. That's the main thing.
Oh, it's the permanent Canadian state. Irritated.
Yeah, exactly. Yeah.
Does it look like the substantial rise in interest rates in Canada is now resulting in lower home prices, lower sales, and increasing inventory?
It definitely is hitting lower sales. I mean, you got to find people that are, we talked a minute ago about the new home buyer, and they're not qualifying as easily anymore. But there's also something called the move-up buyer. It's very important. The move-up buyer is somebody who's selling a house and buying another house. So there's two sales involved in that person with that family. And when you look at the expensive homes that are sitting on the market now, obviously there's people that maybe would have liked to have moved up. That's in the normal course of events. But now they're faced with selling their current home plus borrowing some more money to get into the bigger home or the more expensive home. And the higher interest rates seem to have really put a damper on that. But, it's interesting because the move-up buyers actually, psychologically, it's hard to get your head around this. But if you own a home that was $1 million and it goes down to $750,000, you've lost $250,000. But if the home you wanted to buy was $3 million and now it's dropped to $2 million, you're way better off to sell if you really what you want to do is move up. The gap has shrunk substantially, right? The gap has shrunk from $2 million down to $1.25 million. I think if I'm doing the math right here. So it's a huge improvement in the relative value, but people generally don't see that. They see that the bigger house that they want to buy has come down, but they don't like the idea of selling at a loss. And also, it's more difficult to sell in this market. So when things were hot, people were buying the $2 million house before they sold the $1 million house, or the $3 million house in that example. So now people are reluctant to do that. And once you start putting an offer on a home contingent on the sale of your home, things really slow down. Nobody likes that, and it gets really messy.
What's happening in the new home market?
Well, the big thing in the new home market is immigration, right? So, which they use that term immigration, but actually that's a permanent move, somebody from another country into Canada, and almost all of the a guy named Ben Rabideau, as some people might want to follow on Twitter. He puts out some good charts on this, and it looks to me from those charts that almost all of the new arrivals in Canada have been temporary. So there's a category called temporary worker, and it also obviously foreign students who are also temporary, and they only become immigrants if they get permanent status. So but they are all of those the numbers. There's a lot more talk about it a couple of months ago than there is now, but the numbers were enormous. Like we're talking 700,000 or something, way above the normal. Normally we get about 1% additional people into Canada, 1.5 at the most. So 300,000 to 400,000 people on 30. Say on 40 million, that would be 400,000 people, maybe 400,000 to 500,000. Well, the last few years we've gotten an extra huge number, hundreds of thousands of people, but it's almost all in the temporary category, in the foreign students and the foreign workers. And we don't know if those people are going to stay or if they go back or whatever. But those people are all potential. If they do stay, they're all potential new home buyers. So the as far as I know, most of the new homes in the high-rise category are really suffering from lack of buyers right now in Toronto and Vancouver. In the low-rise, like the single-family homes in Alberta, things are doing really well in the new home market, and it's because people are moving to Alberta. A substantial number of people. Now, these aren't immigrants; they're already in Canada, so they're not classified as immigrants. They're just moving from one province to the other, and so the new home sales are doing quite well. And that, as long as they're priced at a low enough point where people can qualify for the loan. But yeah, it's almost all of the new building now is switched over to rental. Purpose-built rental, they call it, because the condo market is just dead right now.
In the Vancouver area, we're hearing detached sales are the worst in 40 years, even though there is substantially more product than has been built over the years. Is this a red flag?
Well, I mean, the Vancouver area is, as we talked about a few minutes ago, is unusual in that, first of all, it's very expensive. The low-rise single-family detached home is so expensive that families just cannot afford them, and so the sales collapse is probably a result of the absence of the speculator. So the speculator could be a local homegrown speculator that somehow has managed to get a few dollars together and is trying to flip a house, or they could be foreign people coming in from China or some other country that are trying to get a foothold in Canada by buying a home and bringing lots of money with them to do it. And if those two sources of money have dried up, then it's going to be very bad. I see there's one of the realtors on Twitter puts out, or on X, I guess it's called, they put out a regular report of the number of new listings and the number of new detached home sales. And it's been abysmal for months now. It's like every week. It's just brutal. There'll be 100 new listings and only 50 new homes sold. So, or 100 new listings and only 50 homes sold in the resale market, not in the new home market. So those homes are just building up. And in the Edmonton area where I watch it in our neighborhood anyway, the lower price stuff is still moving, is still selling, but the higher price stuff is just sitting. And there's one place near us that was listed at $3 million. They dropped the price to $2 million. It still hasn't sold. So it's very, very difficult at the expensive end of the market. Talked to one realtor and they said that there's been no sales in the $2 million and up category in Edmonton for quite a long time now. I think she might have even said a couple of years or longer. So yeah, I mean, this is the thing that happens when people generally know, but the number of people that actually have $2 or $3 million cash to buy a home is so tiny that it's not enough to support a market. So you're talking about people that are going to be borrowing money, and now they're getting into the mortgage of $1 million or more. The cost of that mortgage is just very difficult.
Yeah, a high-end home in West Vancouver recently sold for 31% below the most recent assessment. Another one sold nearly 35% below its most recent assessment. Do the prices of high-end homes drop first, with a domino effect hitting the rest of the market? Yeah,
well, what pushes well, first of all, the answer is yes. The bigger drops in more noticeable, sizable percentage drops, like these 30 to 35%, you're getting into the realm of a housing crash at that point. Assuming the assessment reflected what the price was a few years ago, those numbers you generally see those more on the expensive homes. Like, it's not unusual in, say, West Van for a home that was listed at $10 million to sell for $7 million in a downturn. But it's not as common that you'd have a $500,000 home selling for $350,000. That would be quite unusual. So yeah, that's where you see it first. And often it's because, there's several possible reasons. One of them is there's a lot more borrowed money involved if it was a speculator. I think most of the speculators will be gone if they're not already. And then there's very few buyers. So if it's a desperate seller, there's a bunch of different possibilities when you start thinking about a seller that has an expensive home. One of them is that they're money launderers, and in that case, they don't care that much. They just want to sell the home because getting the money out of the home and then investing it in something else is a way to clean up the money, from dirty money to clean money. You could sell a home, go to an investment firm and say, here's the money, and this, investment firms are required to say, what's the source of the money? Well, the source of the money is I sold that home in West Van. Oh, okay, that's fine. And no more explanation needed, right? So that's called money laundering. And if that's the case, then that's prices, the most important thing there is just to get it sold, not what price you get for it. If it's in a lot of cases in these expensive homes, the people will be elderly, and if the people had died and they have children who are inheriting the money, again, they might decide to just get it sold. Don't worry about the price. They're not as emotionally attached to the price as mom and dad were, and they just want the money. So they just say, sell it for whatever you can get for it, right? So there's two instances where people wouldn't be so price sensitive to a big drop like 30 or 40%. And then another one would be maybe there's a business setback. So maybe these people own a big business and there's a business setback and they need the money to help their business, or maybe they're in trouble on a loan with the bank for the business or some other thing, and selling the home is the fastest way to make the bank happy. So there's all kinds of possibilities, and but it's probably more likely that those kind of things happen on the more expensive homes, and less likely to happen on the cheaper homes.
What is negative amortization, and is it now an issue in the Canadian real estate market?
Well, it for sure is an issue, and what they mean by that is people are not able to pay the mortgage. So the mortgage, there's an interest component and a principal component in a mortgage payment every month. And you're required, whether it's 25 years we talked about a minute ago, or 30 or 40 years, you're required by law to pay down the mortgage over time. Otherwise, it's not a mortgage anymore. It's just a bank loan or a HELOC or something like that. And there's different rules for that. So there's a special rule for mortgages to buy houses. Goes back to the 1930s or 1940s. I don't know how far it goes back. And what the rule is, you have to pay off a portion of the mortgage every month. And the reason for that was that by the time you're 50 or 60 years old, the house would be paid off, and then you could retire and you wouldn't have that big mortgage payment hanging over you. So negative amortization is all a new thing that they've introduced, as we discussed, where people can't afford the payments, where they would be paying down the mortgage every month. So now they're paying interest only, or in some cases, they're not even able to pay the interest on the mortgage. You and I talked at some point in the past about Hyman Minsky and his cycles of finance, and the last cycle before the collapse in a financial cycle is what he calls Ponzi finance, where there's new money required every month just for people to make their payments. Never mind, they can't pay the principal on their loan. They can't pay the interest on the loan. They need to borrow or get new money in even to pay the interest on the loan. So that's what negative amortization is. That's where people are in such bad shape that they can't even afford the interest, the full interest payment on their loan, much less the principal on the loan. So it's a very negative development in Canadian mortgage lending, and I'm surprised there isn't more outrage about it, but at the moment, people seem to just have adjusted to it and say, well, it's just part of the cycle, and I think the reason why people aren't as excited about it is if the interest rates came down quickly, then it would get back into a positive amortization cycle instead of a negative amortization. But if you take the possibility of big interest rate cuts off the table, which is what seems to be happening now, then you got to deal with this negative amortization. You can't have that running for very long, because basically that means people are getting deeper and deeper into debt every time they make a mortgage payment, which is crazy.
If people are selling their homes, should they be concerned about pricing to the current market?
Well, people are listing their homes, again, talking to realtors about this recently, at what they think is the price that they should get. So that often that price is called an anchor price, is the price that a similar home on their street a year or two ago got, and they know in their hearts, they know that their house is better than that house for some reason. So if that house sold for $600,000, they're not willing to accept anything less than $600,000, because they know their house is better than that house. But the problem is the market has changed. We just talked a minute ago about 31 and 34%. So people are not willing to make that adjustment. They still have that anchor price in their minds. And talking to realtors, they're saying that people are listing too high, and the only people that come and look at these houses, and then the house is not selling, obviously, because it's not priced to the market. And the only people that are coming to make offers are making insulting offers way below, like 30-40% below the market. Not the market, but what the seller thinks the seller should be getting. And that just leads to anger and resentment and bad feelings. It doesn't lead to a sale. So the realtors are complaining. They say, "Oh, we're getting is insulting offers," but really, what it is people are not pricing to the market. They need to, but generally, people won't do it unless they're forced to. So if somebody's not urgently needing to sell, they just pull their house off the market. And after being insulted a couple of times, they say, I'm just going to take it off the market. But if somebody's pressured in some way, maybe by a bank or some other reason, then they might be willing to adjust their price down to the actual price that it would sell at. And I hear it all the time. People say, I can't sell my house. I can't sell my house in this market. And you say, well, the answer to that is, well, yes, you can. List it at $100. I'll buy it right now. Sight unseen. Oh no, well that's so there's a price at which you can sell your house. It just might not be the price you're expecting to get.
Are China's real estate problems causing real estate problems in Vancouver and the rest of Canada?
Well, China's real estate problems are big. Like there's a we talked about investment in and a boom in Canada and a bubble in Canada. At least I've talked about that. But China's situation, and I mentioned it in my book, but I don't spend a lot of time talking about it, but it's much bigger than the Canadian bubble. So what it was people were buying homes in China to live in, and then they were buying a second and a third home. That was an investment. And these were high-rise buildings where nobody lived in them. They were just empty, but the ownership of a space in that building was considered an investment. And then the music stopped for whatever reason, and a lot of these buildings weren't even finished. The people had already paid. There's a weird thing in China that I think people will be surprised to know, is that you don't put down a down payment for a building that, like an initial deposit. You pay the whole cost of the whole apartment right up front to the developer. It's crazy. And they're very trusting people in China. And then the developer is required to finish that home and deliver it. And almost all of these developers now are in big trouble. So the people that put the payment for the full cost of of course the cost is lower than it is in Canada. It might be 100,000 Canadian dollars or 200,000 Canadian dollars. They're really upset about this. So is it affecting Canada? Well, there's a couple of ways it's affecting Canada. One of them is there were some people probably in the higher income categories that were making good money in China real estate, and then taking some of the profits out of that and moving it into Canadian real estate, especially Vancouver and Toronto, Calgary to some extent. But that's dried up because they've got problems back home. And then the other thing is, and this wouldn't affect the average person, but at the higher level with institutional investors, that sort of thing, a lot of North American institutional investors, pension plans, that sort of thing, had invested in China. And now they're not getting the money back out of that, because the money is the last person who's going to get paid in that scenario is the foreign investor in China. So the first priority of the government in China is to make sure that homeowner gets his unit that he paid for. And so the government's working with the developers to finish off the units where people have paid for the unit already. But And then the Chinese government is helping maybe the authorities that provided the land and the banks that lent the money, all that, the Chinese people again. But the last people in the queue to get taken care of would be the foreign lenders and the foreign investors. And I don't think there'll never be enough money to take care of them. So those people are going to lose their money. And that's going to affect their appetite for real estate back in Canada as well, because they will have lost that money in China. So, yeah, it's having an effect, and it's a global situation. You know, it's to some extent this is happening in the U.S. It's a little bit different. It's one of the fun things to do. It's almost on a daily basis now, is to watch in the U.S. these high-rise office towers selling for, that were originally sold for $150 million. Being sold for $30 million, a drop of 70-80% in value. And there's a few people on X that put tweets out. Hey, you won't believe the latest sale. And these are in big cities like Chicago and San Francisco and Los Angeles and New York. So it isn't like some little lost place somewhere. It's not like a Florida swamp deal that went bad. It's a big city thing with, and it seems to be related to. The last one I saw this morning was $1,100 a square foot. Well, that's just crazy. That wasn't that long ago. $500 a square foot in New York City was the going rate. So that was a situation where prices had just gotten way too high. But the thing is coming down, and it's the other problem, of course, is the story last week in the Globe and Mail on Saturday. It's behind a paywall, but it was about the high-rise office towers in downtown Toronto, and they, of course, during COVID, the visitors to downtown on a daily basis dropped way down. But since then, it's come back. It's rebounded and stabilized, but only at 60% of the previous number of people coming downtown. Well, that's a huge change. So in other words, there's dozens of office towers that are basically not needed anymore. And what's amazing about that is since 2020, when COVID hit, they've still built another 10 towers. I forget exactly what the number was, but some substantial number of towers have been completed since COVID. So there's a big problem with that in Toronto. There's a big problem in Calgary and Edmonton, all the major cities in North America. So it's not just a China problem. It's not just a residential housing problem in Canada. It's a worldwide problem. It's just a function of different types of real estate.
What's happening with commercial real estate in Canada?
Well, in Canada, we've got a, I talked about how bad it was in the U.S. with the high-rise office towers. We've got a similar situation in Canada, but it's not quite as bad. And the reason is that in Canada, the ownership of those buildings is a little different. So the buildings in Canada are owned by pension plans, like the Canada Pension Plan, the Ontario Teachers Pension Plan, the Alberta Investment Management Corp, the BC Investment Corp. They all own real estate. They all own a lot of real estate. They all hired a department of investment managers to invest in real estate. So, and then they went all over the world. They competed with each other to bid the prices up. But anyway, that's another story. But but because of these are institutional investors, life insurance companies, that sort of thing, they are not required to do what's called mark to market, where you have to reflect the current price of the holding in your annual report. So in the U.S., these buildings often are owned by investor groups or hedge funds, that sort of thing. They are required to mark to market, whereas in Canada and other places, it's so that pension plan can hold on to that office tower, which was $150 million. Now it's probably, if they were lucky, it's probably worth $50 million. $100 million loss. They can ignore that. They just pretend that it's the same price as it was when they bought it, and they keep that original price, $150 million in this example, on their balance sheet as an investment. And of course, eventually they'll have to come clean on that. But in the first couple of years after the downturn, they're not forced to do it. So it's a little different in Canada. We've got a commercial real estate bubble that's bursting, but we won't have to face up to it until the private sector, not the pension plans or the life insurance companies or all that kind of people, but the actual speculators or the companies that have owned these things, and then they get into trouble with their lender until that becomes more apparent. It's going to happen. I mean, there's a couple of REITs, real estate investment trusts, that trade on the Toronto stock market where the prices have gone down 60-70% for the value of those shares. and the value of what they own has probably gone down even more. So it is happening, but it's just not as front page news as it is in the U.S.
With work from home and a tough economy, are the values of office towers likely to drop?
Yeah, I think it's a permanent change. I mean, we talked about the problem with office towers in the U.S. and that sort of thing, but you know, the fact is that in Toronto, it's only back to 60% of what it was, and companies since COVID have been pressuring their employees to go back to the office, but the employees are reluctant, and the higher performing employees have a lot of negotiating power, and if they say they want to work from home, the employer is basically being forced to go along with what the employee wants. So it doesn't make sense for before COVID hit. I was thinking about that quite often. I'd go to the office, I'd make a couple of phone calls, I'd do a bunch of emails, do some work writing, and maybe consult with some colleagues for 20 or 30 minutes over lunch or coffee or whatever. And then I drive home, and I'm thinking, heck, I could have done all of that without the commute. Now, in Edmonton, it's not too bad. It's only about 30 minutes each way, but in Toronto and other places, it's an hour each way. So the time that you save, though, is enormous, and you get a lot better work at home done because you're not interrupted. The only thing in that equation, though, that you miss out on is the consultation with colleagues, and sometimes those informal discussions are very valuable. So it seems to be getting to the point where people want to see their coworkers, they want to see their customers face to face, that sort of thing, but they don't have to do it every day. They could go 3 days a week, 2 days a week, something like that, and try to. And it seems like in most cities, it's coming down to Tuesday, Wednesday, Thursday, and Mondays and Fridays are pretty empty. So yeah, it's a permanent change, I think. And the situation is you don't need your own dedicated office if you're only going to be there 2 or 3 days a week. And a lot of that time, at least in my case, I don't even go into the office situation. I go into a meeting room and meet with clients or meet with other colleagues. So you wouldn't need that office space nearly as much as you did before. So the office tower space needed, even if people did go in, 3 or 4 days a week, they wouldn't need nearly as much space. So there's a huge change coming in that, and it's going to hurt some people financially quite badly. I haven't seen the banks recognize that at all yet in terms of lending, but they're not the biggest lenders maybe in the office market. It's more like it would be like this real estate investment trust, life insurance companies, pension plans, that sort of thing. You'll see it impact there first.
Would it be practical for big companies that own office towers to build suites in them for their employees? So have half the building suites and the other half still offices?
Yeah, the people want to live where they work. I don't know. It's like, I want to get away from where I work. Well, there's a couple of problems, but the big one I'll pick first is the office towers are not built for residences. So if you think about the way the windows work, the way the plumbing, just to take plumbing for instance, in a apartment you might have 2 bathrooms with showers and toilets, and then you've got a third plumbing situation in the kitchen, right? Well, in an office tower, it's completely different, right? So you've got one kitchen. A lot of times you only get one kitchen per floor or 0 kitchens per floor in an office tower. And then you've got 1 or 2 centralized bathrooms that would not be suitable for residential at all. So you'd have to completely redo the whole floor plan of an office tower to make it into residential. And that's why you'll see that people are very reluctant to do it. There's a program in some cities where the government will give people money to do it, but the people that are approaching the government to get this subsidy are asking for a very large subsidy because basically they have to start over. Now there are a couple of things that are transferable. The other thing that office towers don't have is they don't have balconies, right? So most high rises, the residences, they want balconies. So on the positive side, there's not a lot of positives in this conversion, but one positive side is the parking. So the parking, you have to have the parking, and parking is very expensive. Digging down deep into the ground is one of the biggest costs of a high-rise building. So that is definitely a positive, and that can be easily reused for residential. So, but that's why you haven't seen a lot of residential conversions, because it doesn't make sense. Most people would say, no, it's just better just to build a brand new building with design for residential, and there's a lot of that going ahead in Canada with the help of the new government program, plus the CMHC lending financing program is very attractive. So you can get financing to build a brand new building for residential, but it's much more difficult to get financial help to do a conversion.
Are the rising interest rates putting small businesses in jeopardy?
Well, yeah. I mean, it's well, first of all, small business is it's a really tough game because, when I think of small business, I think of one person or maybe two people or whatever renting some space in a building and then putting up a shingle to do some service or something like that. Usually these days it's a service. And my impression is very unscientific, but anecdotally, I would say most of those people are barely making enough money left over after paying the landlord and the business tax and the loan, the interest on the loan that they've taken. There's almost nothing left over for a salary for them, right? So they end up working for the landlord, for the city, for the government, collecting taxes, and the bank especially with the interest on the loan. So and not only that, but the interest on the loan for the small business, you can almost never get a loan for small business from a bank unless you put up your house as collateral, right? You have to sign a personal guarantee. So not only is the small business barely making any money, but you're risking your family home in order to be allowed to do it. But people love the idea of starting up a business. Sometimes they succeed. I don't know. The numbers are brutal. It's like even without a big jump in interest rates like we're getting now, even in normal times, something like 90% of all small businesses fail. So you have to be very optimistic or have a great idea to want to do that.
In Great Britain, this is several years ago, they had an opportunity for small business where they said you will be tax-free for 5 years or until you can prove you're making a profit. Could we do that to encourage? Because 70% of jobs roughly in Canada and the U.S. are from small business.
Yeah, generally small businesses don't pay taxes, right? Yeah. So, I mean, they don't pay income taxes. I think that's what you're talking about, is income tax. They do pay business taxes, and it's difficult. It's very difficult. It's like, over the years, I've talked to people who start up small businesses, and most of them, if they were willing to be very honest with you, they'd say, you know what, I wish I'd just gotten a job, 8 to 5 or 8 to 4, 40-hour-a-week job that paid me, 60, 70, 80,000 a year, would be with much less stress than a small business. So it's, taxes. I always laugh at tax incentives because they don't really incent people in low income, which small business people are almost all low income people, until they're very successul. And most of the tax breaks and tax incentives, they mostly go to people who are already making a lot of money because they're the ones that pay a lot of taxes. Right? The rest of us, they don't pay a lot of taxes, so you can't incent them by tax. And also, they don't really think about taxes when they're making that decision. They're thinking about they've got a great idea, they want to do something special, and that's more the way it's going. Nobody sits down and says, okay, 10 years from now, I'm going to be making $1 million a year. The tax rate right now is 40%. Oh, what if it was 30%, right? I could save $100,000 a year in taxes. Therefore, I'll go ahead and start a business. I don't think so. That's not the way it works.
Could Canadian banks and credit unions be a victim of all the lending they've been doing?
Absolutely. The biggest business for Canadian banks, although they do not, when they do their quarterly and annual reports, they do not highlight this, is what's called retail lending, which the biggest component of that is mortgage lending, then HELOCs, then credit cards, then car loans, then whatever else, whatever kind of lending. They used to be big lenders to businesses and stuff like that, but they've gradually moved away from that over the decades. And credit unions are almost all, of course, by definition, lending to individuals, retail lending. So when the cycle turns and 98, 99% of all the collateral banks for retail lending and credit unions have to back up these loans is real estate, right? So if real estate prices drop 30%, as we were talking a few minutes ago, all the banks and all the credit unions are going to be impacted by that. And they, as long as of course, the borrower, the Canadian individual will keep making those payments because they've got to have a place to live and they're embarrassed to walk away. I mean, it would be horrible to default on a mortgage. It would be very un-Canadian. So the banks will be, and the credit unions will be protected for a while, but if it lasts for long enough, then people will start saying, "Hey, wait a minute, I'm just working for the bank here. I'm losing money every month, and the only person that's getting paid is the bank." So at some point, if it gets bad enough or lasts long enough, then the impact will be there. But don't cry for them, because in the case of the banks, they're federally regulated and they'll be helped by the federal government. And in the case of the credit unions, they're mostly provincially regulated, and they may not get helped as much, but most of them did. In the financial crisis in the 1980s, all the credit unions in Alberta, and I think most provinces, were given 100% guarantee on their deposits, because otherwise they were going to lose all their customers. So there will be help from the government for them. There won't be help for the homeowner that loses 30-40%, but there'll be help for the banks and the credit unions for sure.
British Columbia provincial credit rating was recently downgraded from AA to AA- due to deficit expenditures. This is the third downgrade in 4 years. What could this mean for BC?
Well, it's funny, I wasn't looking at BC, but I was just looking at the U.S. federal government. The U.S. federal government has a AA. One of the ratings agencies still has it as AAA, and the other one has a AA+. And the Canadian government has a AAA rating, and the German government, I believe, has a AAA rating. But there's very few governments in the world now that have a AAA rating anymore. So, and I think the Canadian rating is definitely in trouble, and the U.S. government rating U.S. government rating got downgraded when, I think it was 2011, when we had that debt payment ceiling. They wasn't adjusted, and the government had to shut down for a few weeks, and one of the ratings agency dropped it from AAA to AA+. And but the fiscal situation of all governments, I haven't looked specifically at BC, but this fiscal situation of the U.S. government is dire. Like it's absolutely incredibly bad compared to where it was just 10 years ago, or 13 years ago when the last downgrade happened. So the BC government isn't going to be a whole lot better than that. And if the U.S. federal government, or if the Canadian federal government were downgraded, then it's going to impact all of the provinces in Canada, because you can't have a province in Canada have a higher credit rating than a national government like the U.S. government or the Canadian government. So I don't think these ratings mean much. The one thing that could impact BC and Alberta and Canada would be if Canada somehow lost it has this reputation for the last 40 years of being a stable, conservative kind of financial place. It's sort of like a safe haven, and that was reinforced in 2009 when we had the global financial crisis, and Canada didn't have the same. Canada had problems, but it didn't have nearly the problems that the U.S. had, and the United Kingdom had, and other countries had. Australia, Canada, and a few other countries did really well going through 2009. So our credit ratings are all probably higher than they should be, because we have this reputation for being prudent financial managers, which is pretty much, as far as I can tell, undeserved. So at some point, the pendulum will swing, and it'll say, "Hey, wait a minute, those guys aren't as careful as we thought they were." But I don't think we're here yet. A downgrade from AA to AA- isn't going to convince anybody that there's a problem. It would have to be more dire than that.
Could we be heading for the Great Depression 2.0? Well,
the one thing that might do it is, we don't know. Like, there isn't even a recession, a real recession underway yet, although I think there's one coming fairly soon. There's always another recession on the horizon, by the way. It's just over the horizon. Nobody can quite see it until it's actually here. But the reason we would get into a depression 2.0 is because of the necessity of doing something about the debt. So there was a guy named Irving Fisher in the 1930s and another guy named John Maynard Keynes who wrote extensive articles and books about what happened during the Depression. And I've read most of it. And the big problem that we haven't had since then, since the 1930s, is what occurred then is the extinguishment and the extinction of debt. So there's so much debt after 1929. There's so much debt in the system in the U.S. and elsewhere in the world, in Canada, that the debt had to be. They had to wipe out the debt, and the only question at that point is who takes the hit. You know, it's kind of like, how do you distribute the pain? Is it, there's certain people. And of course, in the Great Depression, what happened is everybody took some pain except people that didn't have any debt, which was very few people. So the banks, a lot of the banks went bankrupt, and the governments were in trouble, and of course, a lot of the farmers lost their farms, and homeownership wasn't nearly as widespread then as it is now. So people generally weren't as exposed to the housing market as they are today. But that would be what would cause a depression, would be if that debt was rapidly and destructively voided. Now, there are arguments out there for something what's called a jubilee, where you just do a blanket amnesty of debt, and that allows people to start spending money again and all that sort of stuff. But politically, a jubilee would not work, because what people would say was, why did that guy who had all that debt, and he bought 4 houses, and he shouldn't get forgiven his debt? And when I was careful, it's just too unequal, and people would get really, really angry about that. So you sort of have to go through this debt destruction cycle, which unfortunately we haven't had for so long now that the problem is built up to quite a large amount, and that would be what would cause a depression. I don't know if it's going to happen. It seems like people are okay with some inflation in if the government prints a little more money and maybe extinguishes the debt by just making the value of money less and less, which means the value of the debt goes down as well, then that's the route that they're probably going to take. But if they decide to go through the debt deflation that we had in the 1930s, then you would have another depression for sure.
Tesla recently made its 6 millionth vehicle. In the media, we're hearing that people don't want electric vehicles. Tesla currently has the best-selling car in the world. What's really happening with EV sales?
Yeah, Tesla had a report for the period ending March 31st, 2024, where they sold fewer vehicles than the year before. They've never had that. They've had sort of annual gains that have been, I think the target at one point was 50% annual gains. So that's only one quarter. It's not the whole year. If the current trend though stayed in place, Tesla would have a lower sales this year than last year. Now, the Tesla management, Elon Musk being the only manager at Tesla, I think, said that he thinks by the end of the year they'll still have a gain in their sales. They've got a number of factories that aren't running at full capacity. And they don't have a lot of new models on the horizon. For several years, they seem to always be coming out with a new model, like the Model Y was very successful, best-selling car in the world. But the Cybertruck is their new model this year, and it's not likely to sell nearly enough units. But the big challenge in the electric vehicle market is what's happening in China. China is bringing out electric vehicles that are much, much, much cheaper than what Tesla has been doing and what the other feeble attempts by the other car makers for electric. Tesla started at the luxury end, and they've gradually been lowering the price, but generally the Chinese offerings are very cheap. Like this one car in China that seems to be a reasonable car. I don't know. I haven't sat in it or seen it close up, but they're talking about $10,000 per unit, right? So that if that comes to Canada, the U.S., it's going to have a huge impact on. So there is still demand for electric cars, but it's slowed down a little bit, but it won't change the fact that in the long run, all the cars will switch over to electric at some point, whether it be 2030 or 2035 or 2040, somewhere in that time frame. And because they're going to be cheaper than regular cars, and their annual costs of ownership are much lower. And so it's inevitable, even if people didn't care about reducing CO2 emissions. But it's, as I think the person that knows the most about it in the world is Elon Musk, and what he says is that they're ended the first growth phase. 2024 is going to be a transition year, and then the new growth phase is going to start again. But he's counting on what he calls the autonomous vehicle, the robotaxi. So he's counting on that to boost sales later on. And of course, that might be more than 1 year away. I don't know. I've got it on my car. I use it quite a bit now. It's wonderful. It's very, very helpful. It's not as tiring to drive the car because the car does the driving for you. But it's not ready to be unleashed on the world. It still makes mistakes, right? So I don't know if the mistakes would result in an accident, because what the mistakes I see, which are fairly small and few and far between, but still they happen. What the driver does, I take over the car because I don't want to find out what happens after I see it making a mistake. So if it was a robotaxi, there'd be nobody there to take it over, so you wouldn't know what would happen. And probably, most likely, what happened is the car would stop itself before it crashed into anything, and then it would just sit there. Right? Now, that's not going to make a lot of people in traffic happy if you got a bunch of robotaxis that can't figure out what to do next, just sitting in the middle of the road. So I'd say it's at least a year or two away from being perfect. Now, there is a new version coming out. I've got 11.8 or something, and the new version is called 12.4. And Elon Musk says that's going to be a big improvement. So I'll wait and see. Maybe we can talk about that next time.
Have you driven a Cybertruck yet?
No, I'd love to, though. I was looking at a YouTube video or something, and it looks absolutely amazing. Like it's the people that have driven them and they've written about it to say that it's like an entirely new vehicle. Like they put an awful lot of new technology into it. First, it's drive-by-wire, so the steering wheel is not connected directly. It's done by electronic waves through the air, and it's computer assisted, of course. And so all the wheels can move independently, like the rear wheels and the front wheels can move together to make a very tight turning circle, for example, and that's really good for off-road applications and stuff. But it's a huge vehicle. Like, I don't know, it'd be fun to drive it around, but it's much bigger than a regular vehicle. So I don't know what the application is going to be. I've seen a version of it where you can use it as a tent, like the back lifts up and you got this living accommodation that you can put in the back with a bed, a couple of beds, and so I don't know if you can have a TV in there, or I don't think there's any room for a refrigerator. I don't think there's a shower, but anyway, I'd love to drive one, but I don't think I'd get one.
Where can people follow you?
So I'm on X at HMACBE, and also people can subscribe to my weekend note. Every week I write a short note, 500 words, about these topics, ones like we've been discussing. And this week comes out on Friday. This week it's going to be about the U.S. government debt and deficit, which is, as I mentioned, in a deep and dire state. So you can find it on. Or you can go to MacBeth.McLeodPartners.com and sign up there. You can find it on X and sign up for it. I think you'll find it interesting.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim. It's been great.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from the Director of Marketing for RecycLiCo, Tony Mitchell. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. My guest is Tony Mitchell, Director of Marketing for RecycLiCo. Tony, welcome back to Company Showcase.
Hey, Jim.
How are things going at RecycLiCo?
Well, Jim, all's going well. Everything is smoothly moving ahead on our Taiwan joint venture. The team is busy moving through the various stages of testing for multiple potential joint venture partners, and operations are proceeding at a steady state. But that said, as Director of Marketing, it pains me to not be able to talk about some great things we're working on behind the scenes. But when Richard and the team are ready to pull back the covers, I look forward to telling our loyal listeners all about a future podcast.
Is the recent downturn in the EV industry having an effect on RecycLiCo's plans for recycling lithium-ion batteries?
Not at all, Jim. Although the EV industry has seen a significant number of layoffs in recent weeks, with Tesla being the most prominent example, I personally see this as a relatively short-term speed bump on the world's transition to EVs from internal combustion-powered vehicles. As competition in the marketplace heats up and the industry continues to evolve, companies will need to adapt and make difficult decisions to ensure their long-term success. And, when you look at the EV rollouts of OEMs such as Toyota, Mercedes, BMW, Ford, etc., you quickly realize their EV offerings currently represent a small portion, a really, really small portion of their massive total production capacity, which is still primarily tooled for production of internal combustion engines and hybrid powertrains too, of course. Or they're in the process of building out brand new EV production facilities around the world, such as Honda's recent announcement, I don't know if you've seen it, that they will be building a $15 billion EV plant in Ontario, which happens to be the largest auto investment in Canadian history. So with that in mind, while the billions of dollars the OEMs are each spending on EV development, clearly signals they're committed to going fully electric in the relatively near future, battery technology and the consumer demand for the high-powered charging infrastructure to support them must ramp up and sync with production. Years ago, Elon and Tesla recognized this need from the very beginning, which is pretty prescient in that respect, and continue to build out and upgrade the world's largest supercharging network in sync with their vehicle production. And, Tesla's supercharger network now is the shining jewel in their massive business plan, and has given them a huge advantage over anyone else trying to gain market share of the nascent EV industry. And in fact, Ford, Rivian, Nissan, and Hyundai recently realized this and decided that, if you can't beat them, join them. So they've incorporated Tesla's NACS charging ports into their vehicles, which will give them an advantage over any other brands who choose to go it alone and, build out their own charging networks. So, Jim, with that in mind, I believe, as many others in the industry do, that it primarily comes down to the challenges of refueling an EV. Because, once the number of refueling stations and the time required to refuel an EV is on par with refueling a gas-powered vehicle of similar range and price, it's really game over for internal combustion engine-powered vehicles. Think about it, Jim. When was the last time you looked under the hood of your car? Do you care how it's powered and gets you from point A to B? Or do you care more about how dependable it is and how often you have to refuel it and or service it? That's what it really boils down to for the majority of drivers out there. Now, this isn't going to take place overnight. But, as I've said before, when you look at how things are coming together with all the charts out there, EVs replacing ICE vehicles is really an inevitability at this point, and it's just a matter of time. And, it's funny, this situation, I'm talking to a few different people, it's kind of funny, I keep bringing up this quote because It's a great quote from one of my favorite sci-fi authors and fellow Vancouverite, actually, is William Gibson. The future is here. It's just not evenly distributed. So while you can buy a premium EV like a 2025 Porsche Taycan today that allows 800-volt charging, which means it can be charged from 10 to 80% in just 18 minutes, there's a much smaller network of chargers available for drivers to do so. However, as Tesla continues to build out new sites and upgrade their existing charger network, along with their goal of producing an inexpensive EV for the mass market, and the battery industry produces batteries and vehicles with higher voltage charging, the refueling time gap between internal combustion engine vehicles and EVs will be very close, and things will get very interesting in the near future. So I'll end this podcast on that fact, while pairing it with other facts such as, battery scrap rates are still as high as 30% in battery production facilities, and the RecycLiCo patented process can recover 99% of those battery-grade materials for direct reuse in new battery production on site at the factory, not having to ship it around and get the materials back and pay a premium and so on. And another fact is that many of the world's first generation of EVs using much less efficient battery technology, from back in 2011 and so on, are coming up on their end of life. And the battery materials within them are ready to be recovered and upcycled for use in brand new, much more efficient batteries. Let's just say the timing of getting our first clean spot battery recycling and upcycling plant running in Taiwan is only getting better as demand for integrating our revolutionary recycling process continues to grow around the world.
Tony, where is RecycLiCo traded, and how can people get more information about the company?
Jim, we're traded on the TSX Venture under the ticker symbol AMY, on the OTCQB under the ticker symbol AMYZF, and on the Frankfurt Stock Exchange under the ticker symbol ID4. And you can get more information on our website at RecycLiCo.com.
Tony, thank you so much for the update.
Thank you, Jim.
My guest has been Tony Mitchell, Director of Marketing for RecycLiCo. I'm Jim Goddard. Our conversation took place on May 9th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.